Hi, welcome to Let's Talk Bonds, the weekly podcast from INR Bonds. I'm Arjun Patsati. And Let's Talk Bonds is a podcast where we talk about the best bond options, investment options available in the fixed income market for investors. And in this week, Let's Talk Bonds podcast, we talk about the best bonds when the Fed, at the time when the Fed has started hiking rates, interest rates. And will continue to do so for this year and the next year. And with the 2 year period where interest rates are going to rise in the US and globally as well, because Fed is a policy setter almost for the global central banks. RBI too will have to start normalizing interest rates because RBI has kept rates at record low and inflation is high in the economy and there is a lot of pricing pressures across. And all this will have to filter down to rate hikes. In fact, the 10-year government bond yield has already started to factor in multiple rate hikes over a period of a couple of years, maybe or more. And the 10-year yield is at 6.8%, while the repo rate, which is a RBI benchmark rate, is at 4%. So in this scenario, it is clear that investors will have to make investments in such a way that they are positioned for higher interest rates over the next continuously rising interest rates over the next 1 to 2 years. Most of the rise in rates will come in the next maybe 1.5 years. And after that, it should stabilize unless inflation surprises much higher on the upside. And then the interest rates can continue to go up. So in this kind of investment in the interest rate cycle, the best investments clearly, the options available to the investors are clearly there to see, as in that there are GSEC yields up to 5 years are still below 6%. So clearly, inflation is at 6%. You're earning nothing. 2 year, if you want to go down, if you want to go longer, then you get higher yields, but then you still face the prospect of falling prices as yields rise on higher inflation. And so even 10-year GSEC yield at 6.8% or even a 10-year state development loan at 7.2% may not be attractive enough at this point of time. There will be a time when these become attractive, but not at this point of time. And in corporate bonds, in the Bharat Bond ETF too, which is very popular with investors given its ease of investments and its capital gains treatment. You still have 5 year bond at below 6%, again yielding nothing, and the 10-year is at 7%. But 10-year yield is susceptible to higher interest rates and falling NAVs, which will eat into your returns over a period of time, next 2 years at least. So in the corporate bond space, AAA bonds are below AAA bonds for 2 to 3 years are in a range of below 6% to 6.5%. 5 years are around 6.5 to 7, maybe 7 quarter, and 10-year bonds are at over 7%, maybe even going up to 8% or higher for other AA plus issuers. And in the lower yielding space, clearly, lower rated bonds or higher yielding bonds, you have good options available. Here, the rates could be anywhere between 8% for 1 year bonds, or 7.5 to 8% for 1 year bonds, going all the way up to 10% or even 11% for 2 to 5 year bonds, depending on which issuer. For example, in INR bonds, Quick Invest app, we have listed bonds like TVS Credit, which is a subsidiary of Tata Motors. It's a 2.5 year maturity bond, around 8.5%. You have Swatantra Microfinance, which is a microfinance company run by the Kumar Birla family. 1.5 years to 5 year bonds in a range of around 9.5 or over percent to closer to 11%. You have bonds like Shriram Transport and other microfinance companies around similar levels. Bonds like Shriram Transport, 2 to 3 year bonds in a range of 8.5 to 9%. You have 10-year bonds, perpetual bonds of the Cholamandalam at over 9%. You have SBI perpetual bonds, which is 2, 3, 4, and 5 year maturity ranging from almost 6.5% to 7.5%. So these are some other Bank of Baroda 5-year bond is over 7.75%. So these are some of the options available for investors. And the higher the yields they get and the shorter the maturity, they are well protected from the Fed rate hike cycle. And the investors have to search for the best bonds available in the 1 to 2 year, or maybe 2.5 or maximum 3-year maturity. If they can get yields around 8 to 10%, depending on the issuer, then they're able to get a good sense of the ability of the issuer to service debt and bonds, and are reasonably sure of their understanding of the issuer, then they do make some good investments. Tax-free bonds, as we all know, are very low. So 1 to 2 year PSU tax-free, all the tax-free bonds are PSU bonds, are in a range of around 3.5% to maximum 4%. And the longer ones, 4 to even 10-year bonds, are in a range of around 4.4% to 4.6%, or maybe slightly higher, but not too much higher. So tax-free bonds do not give too much, but then investors looking for safety and tax-free returns do still invest in tax-free bonds. And typically, these tax-free bond yields do tend to go up when rate hikes do happen. But given that tax-free bonds are not going to be an issue any longer, then the scarcity premium could well be very high and keep yields from rising too fast. So that's where it is. And in the private placement space last week, we had bonds like we had issuers like NHAI issuing 15-year bonds at 7.1%. These are long-dated bonds. India Infrastructure Finance Company Limited, there's a 10-year bond at 7.17%. We had Tata Capital Housing issuing 10-year bond at 7.5%. Tata Capital typically resonates with investors, but it's still a very long maturity bond. Royal Sundaram General Insurance 10-year bond at 8.05%, CAA plus rated. Niva Bupa Healthcare Insurance, which is an A-rated issuer, they raised 10-year bond at 10.7%. This is a high level. Then you had DME Development Limited. We talked about it in Bond Bites this week, where they issued a 3-month floating rate bond with a spread of very attractive spread of 311 basis points over the 3-month treasury bill. They offered it in a strip format, that is STRPP, separately tradable, redeemable principal parts bond, 6 to 15 years of maturity, and with a very attractive spread. So this bond saw, for a 5,000 crore issue, rupees 5,000 crore issue, they saw interest coming in at for almost rupees 1 lakh crores. Even shows that the pricing is very good. And Shriram Transport too came out with a 2-year floating rate bond, which again 3-month T-bill link plus 2.44%. Again, better than DME. So this is a very good price for Shriram. Then you had Vivriti Capital Private Limited. It's a regular issue of MLDs. They issued a GSEC link MLD. This is A-rated over 10% levels. And Navi Finserv again raised a 2-year MLD in GSEC at over 9%, 9% levels. So that's the private placement for this for the last week. Thank you very much for listening in. Do download our Quick Invest Buy and our Bonds app and get in touch with us for the best bonds. If you're a financial advisor, for solutions for your clients and best bonds for your clients. And if you're an investor, just see the bonds, take the information, and contact us for support if you require for a seamless in-app investment purchase. Thank you very much for listening.